Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, Matt Forrester is back with us. He's the Chief Investment Officer with BNY Mellon Lockwood to discuss adjusting for the new macro realities in the market. It is great to see you as always, Matt. Welcome back to Trade Talks.
Thanks, Jill. Good to be here.
And we know macro is driving the markets, particularly in the vacuum of earnings. Are we in the teeth of a bear market right now?
We're in the maw of the bear, and every once in a while the bear is going to open up its jaws and give us a little breathing room, but then it's going to come back and chomp us some more, I'm afraid. So yeah, we're in a macro-driven market. We're driven by concerns about Federal Reserve policy and how rapidly this tightening policy is progressing. We're worried about the outlook for inflation. Geopolitics has been particularly troublesome, I think, lately. And here today, we're in the midst of some energy supply concerns with what's going on with Nord Stream 2. We've had tremendous amounts of FX volatility. Again, these are all macro concerns, and they're affecting stock and bond and FX markets around the globe. So, these are the concerns of the day, and I think they're kind of overwhelming any of the kind of micro factors that markets are normally concerned with.
Yeah, and you're right. I mean, any one of those factors could potentially be a market shock. I mean, you have the confluence of them all acting together. It really does, change the calculus of how you approach it fundamentally. What is the sacrifice ratio, and why does it paint a difficult picture for growth in the next several quarters and the possibility of a longer, more protracted recession?
Yeah, this is one of those kind of esoteric macro metrics that normally markets don't think about. And we haven't had to think about these things for 4 decades, but we need to think about them now. And the sacrifice ratio is the amount of GDP that we're going to need to give up or sacrifice in order to get a 1% decline in inflation. Now, this is just a ratio that's derived from history, and it's possible that these are changing. And in the US economy, it's possible that they've gotten a little better over decades. But so if we look at the average since 1970, the US economy has had to give up 1.7% in GDP in order to get a 1% decline in inflation. Recently in the 90s or in the 2000s, that was about 1.7. The average has been about 1.4 over a longer period of time. So, but if it's anywhere near this, we're going to have to give up a lot of output in order to get inflation lower. It's a very sobering reality for markets and what might need to happen in order to get inflation to decline. And I think this is exactly what the markets are concerned about. They're concerned about the depth and the duration of a potential recession, which looks increasingly likely and more difficult to avoid. But the sacrifice ratio is not painting a particularly good picture for what we're going to need to go through in the next 4 to 6 quarters maybe in order to digest what the Fed has already done in order to try to curtail inflation. And I think that's what markets are reacting to. That's why we're in the teeth of the bear market right now.
Now, what about the one bright spot, which has been employment, and it still remains tight? Any thoughts around employment and available jobs?
Exactly. So that's the other piece, which I think is offering a little bit more of a hopeful sign. And again, if we look at another esoteric ratio, one which Jay Powell has mentioned several times in recent speeches, which is the Beveridge ratio. It's the ratio of job openings to actual unemployment. That's about the strongest that we've ever seen in the US economy, or the modern US economy. It's over 1.8. So the numbers from the JOLT survey related to unemployment is still very high. And the Fed is hopeful that we can have a job-full growth recession. We can still continue to keep jobs relatively unaffected, the unemployment relatively affected. They'd like to see the job openings actually come in. That did not happen in the latest month's number, which I think is what's giving the Fed a little bit of concern, is that they're having trouble slowing this down, slowing inflation down. But if we can keep job openings coming in and the unemployment rate selling relatively stable, then there's some hope that this might not affect the real economy. Financial markets are going to react very quickly to anything that the Fed does. Look what's going on over the UK. We've had almost an immediate reaction to what the UK authorities and a new administration there under Prime Minister Truss and the comptroller have offered. Markets react very quickly, but it takes longer for the real economies to react to these policies. And so the Fed is hopeful that they can have a window of time here where they can really increase interest rates a lot, try to slow down inflation, their first mandate, without affecting their second mandate of employment all that unduly much. So hopefully that's what happens, and that's a little bit more hopeful for how the U.S. economy and this recession might begin to proceed as we go through time.
Right. And Matt, you had said before anywhere from, 4 to 6 quarters of this, another 12 to 18 months out. So clearly investors have to be patient. To your point, the market reacts on a headline, but that's not how it plays out. So with this backdrop, what does it imply for investors?
Sure. So monetary policy, the famous line, has long and variable lags. So the effects of the Fed tightenings that we've already gone through are going to be felt. And it's not, it's very clear the Fed doesn't seem to be done with its current tightening policy. And the concerns about the market have been driven around what this terminal rate is going to be. Where is the Fed actually going to end up with their tightening process? But the effects of that on the real economy aren't going to be felt for 12 to 18 months is kind of the rule of thumb on average, and that might take longer, and that's a little bit of a concern. The good news might be, and so we saw some of this today. We've started some news around apartment rentals and the Case-Shiller Index, which is the survey of house prices in 20 cities. They both started to show some month-over-month sort of declines, very short-term declines that we really haven't seen. In fact, the first time the Case-Shiller has declined is something like 12 years since March of 2012, over 10 years since we've seen any kind of movement down in the house price index. Those things might be a little hopeful, but will probably take time to show up in inflation. And I think the Fed is very concerned that we see seasonal lulls in inflation like we did last summer. June to September of last year, we kind of stalled at this 5.3 to 5.4 on inflation before we ran up another couple of points. So I think the Fed is going to need to actually see meaningful movement in the inflation months after months before they're going to change their tune about what's actually going on in their policy and whether there's any hope for a change of policy. I don't really see it right now, and I think the markets have begun to come around to that position that it's going to take longer for them to change their tune.
All right, Matt, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Joe.